Welcome to Talk Tickers. Today, we're breaking down LendingTree's pivotal third-quarter earnings call. And believe me, this was a big one. Not just because of the numbers, but also because of a huge leadership transition right in the middle of it.
So, right off the bat, the market's reaction. A pop of over 6%. Investors clearly liked what they saw. The big question is, why? What exactly got them so confident? Well, to figure that out, we've got to dive into the numbers.
All right, first things first. Let's look at those headline numbers. How did they stack up against what Wall Street was hoping for?
And wow, it was a clean sweep. Just look at this. Adjusted EPS came in at $1.70, totally smashing the street's estimate of about $1.23. Then you've got revenue, also a huge beat, coming in way ahead of expectations. And maybe the most eye-popping number here, that adjusted EBITDA, up a whopping 48% from last year. This is actually their sixth straight quarter of revenue growth, so we're talking about some serious, undeniable momentum here.
Okay, so a big beat is great. But what's really interesting, what tells the real story here is where all that growth came from. Because it says a ton about the health of the entire business.
And here's the key takeaway. This wasn't just one part of the company carrying all the weight. Not at all. The growth was everywhere. The insurance segment, which is their biggest, grew a solid 20%. The consumer side was up 11%. And get this, even in this crazy tough housing market, their home segment grew 18%. When you see double-digit growth across all your main businesses, yeah, that's a very healthy sign.
So let's zero in on that insurance segment for a second, because it really was the powerhouse this quarter. The new CEO, Scott Peyree, pointed to something super interesting on the call. He said that spending from their partners, not just the top three, but the next tier down, the 4th through 10th largest carriers, their spending shot up by almost 60%. That is huge. It shows that their marketplace has real depth. They're not just relying on a couple of big players anymore.
And like I said, this wasn't just an insurance story. The momentum was everywhere. Over in the consumer business, small business loans were a huge driver. And in the home segment, their home equity product was on fire, with revenue jumping 35% as people tapped into their equity. And when you put it all together, what does it do? It drives up this really important profitability metric they call variable marketing margin, or VMM. That was up 21% to over $93 million.
Okay, so the numbers look fantastic, right? But that's only half the story of this quarter. There was some massive stuff happening behind the scenes, both with the company's leadership and its finances.
Really, you can boil the quarter down to two huge events. First, back in August, they made a really smart move and locked in a new credit facility. We'll talk more about that in a sec. But then, in October, something really tragic and unexpected happened. The company's founder and CEO, Doug Lebda, passed away. The board, to its credit, moved very quickly. They appointed the former COO, Scott Peyree, as the new CEO, which was a clear signal to the market that they were focused on continuity and keeping the operation steady.
Okay, so let's circle back to that new credit facility, because this is a really big deal. They basically swapped out an old restrictive loan for a brand new one, and this new deal is so much better. It gets rid of these things called operating covenants, which are basically a bunch of restrictive rules the lenders put on you. Without those, management has way more freedom to run the business. And on top of that, they got their net leverage down to a really healthy 2.6 times. That just takes a ton of financial risk off the table.
So the new CEO has all this flexibility. What's he going to do with it? Well, during the Q&A part of the call, he laid out a super clear, no-nonsense plan. Priority number 1, the default move, pay down debt. Simple. After that, it's all about running the business well and making smart investments in things like AI to make the customer experience better. Nothing flashy, just good, solid, disciplined execution.
All right, so that's the story of the quarter. Great performance and some major strategic shifts. Now, let's look forward. What did they say about the future? Let's get into the guidance and our final rating.
And this, right here, is a massive vote of confidence from management. They didn't just have a great quarter and leave it at that. Nope, they backed it up by raising their guidance for the entire year. They bumped up their targets for revenue, for VMM, and for adjusted EBITDA. That's a pretty clear signal that they think this momentum is going to keep on rolling.
So all of this brings us to the big question for anyone looking at this stock, right? You've got strong results, a new CEO at the helm, a much safer balance sheet. So where does LendingTree go from here?
Okay, so here's how we're looking at it. That guidance they raised, yeah, it seems totally achievable. The insurance business has strong tailwinds. The balance sheet, as we've said, is so much safer now with that leverage down to 2.6 times. And that growth across all segments,
That's the kind of diversification you love to see. The only real question mark, of course, is the leadership transition, but everything we've seen so far points to a steady hand on the wheel.
So look, when you add it all up, you've got the operational momentum, you've de-risked the finances, and you have management confidently raising the bar. The whole setup just looks really compelling. And for that reason, our call was to initiate with an outperform rating.
And of course, just a quick reminder, this is not financial advice.